So this week's outlook. This week we're going to do it a bit differently. Obviously we've got the whole US and Iran tensions. So I figured that we would start off in the actual geopolitics page, which is a new feature we added. And we'll obviously just quickly summarise all the events that are happening right now. Then we'll go into the calendar to see all the events we're going to be keeping an eye on this week. And then we'll get straight into the fundamental analysis. So starting off with the geopolitics. I mean, it is evident here that there is a lot of tensions surrounding Iran. You can't even call it tensions, there's conflict. There's a bunch of conflicts going on around Iran. I mean, if we just come over here to the intel feed, you can see new strikes light up night in Tehran. So obviously the US and Israel are still bombing Tehran. I think it was just this morning we saw an Iranian oil depot being bombed by the US, which is basically just showing that there aren't many signs of de-escalation coming soon, at least. So yeah, obviously day 9 of the US Israel attacks. All this is just pointing to gold higher, the VIX higher, and equities lower. If we come down to the conflict timeline here, we can see the most recent developments, and we can see that satellite images suggest that Iranian strikes may have damaged US radar sites. Obviously, that's just going to inflict more conflict. Iran has lost nearly 70% of its missile launch capabilities. All this stuff here is just signifying that the conflict is well and alive. I mean, if we come up to the trade implications tab here, you can clearly see that long gold versus AUD, oil disruption contained, escalation is now the $85 plus mark. An all-out war. At the moment, this is an operation. If we do reach an all-out war, $110 plus is what the terminal was suggesting. And obviously, right now, Brent's at 92, crude oil's at 90, gold's at 5159. So yeah, tensions are clearly very high. There's not many signs of de-escalation, and all this to me points to a further rise in oil, a further rise in nat gas, as you can see here. The VIX rising, the Dixie rising, gold rising, all these things. So we'll go over this in more detail, but let's just go straight into the news events we're looking at this week on the calendar. So the calendar this week, what we are looking at, it's a relatively quiet week for data, and obviously we'll be mainly paying attention to how oil moves and then the headlines. But on Monday, you've got Japan's GDP growth, which is forecasted to come in the positive region, which makes a difference from last time. Then we're looking at the next major one I'm looking at is going to be Wednesday, where we have inflation out of the US, which is expected to hold around the 2.5% handle, with a slight 10 basis point uptick in the year-over-year print. Friday, we then have UK GDP, which is forecasted to rise by 10 basis points, nothing crazy. And then we have the GDP growth estimate, Q-on-Q, in the US, which is forecasted to slip by 300 basis points, which is quite a lot. But obviously, GDP is a lagging indicator, so this shouldn't be getting priced in too much. Headline unemployment rate, 6.6% is the forecast in Canada, so we're forecasting to see some labour market deterioration out of Canada, which, to be honest, is not really a surprise given what short end yields are showing us at the moment. And then on Friday, we also have US JOLTS, which is forecasted to actually improve. So obviously that is going to be beneficial for the US. Now, going into the macro analysis. So overall, it is quite evident that we are in an energy-driven market right now. We have US oil breaking the $90 handle, which is something we haven't seen in years, which is obviously leading to LNG and other energy tickers following. So we're obviously seeing a massive push up in LNG, especially with the Strait of Hormuz being potentially closed, and just this morning, as we mentioned, an Iranian oil depot being bombed. This is just going to lead to demand for substitute energies rising, of course. So just like last week, we are looking for clear energy divergences. Regarding the US dollar, we'll start off with the US dollar. We maintain our bullish move. We think that even regarding the weak NFP print on Friday, we saw unemployment rise by 10 basis points and job creation go deep into negative territory. Short-end yields have essentially shrugged it off as the markets believe inflationary pressures from the surge in oil will be enough at the moment for the Fed to remain cautious, or at least on hold for a short period of time until the war sort of de-escalates. But until then, as the war continues, with the Strait of Hormuz being in focus and potentially subject to closing in the short term, US oil is going to remain elevated, which shall continue to direct flows into the greenback from a risk sentiment and commodity perspective. I mean, if you look here, risk sentiment is at 24%, which is extremely weak right now. However, as soon as de-escalation starts to get priced in, we're going to most likely see short-end yields resume to the downside, as obviously we now need to reprice the inflation fears as they're going to have to fall. And then, of course, that will contribute to weakening of the dollar. So it is vital to be on top of the headlines and to reevaluate our thesis day by day. So yeah, I mean, March NFP, it was a dovish print, but markets repriced the majority of the downside push, as it says there. So yeah, essentially, the markets kind of are looking past NFP for as long as the conflict is going on. And I mean, if we just look at what like Credit Agricole is saying here, they're saying that essentially they expect the dollar to stay bid in the near term, obviously due to the US-Iran conflict. Similar thing here from Goldman Sachs, where they're basically just raising oil price forecasts amidst the Hormuz disruptions, and obviously that is bullish for the dollar as well. So yeah, that is essentially all the institutional stuff this week. You'll tend to notice that a lot of the institutions go a bit more quiet when there's a lot of conflict, because obviously they want to be very careful with they almost want to hedge their opinions. But yeah, that is essentially it for the US dollar this week. Very energy driven, and we do foresee upside in the US dollar. Moving on to the pound. We remain bearish on the pound, both from a macro and energy divergence basis, but starting off with the macro, the labour market is evidently weakening. You can see here that unemployment's at 5.2%, the claimant count is at 28,000, which is like still a very like multi-month high. And yeah, data as a whole is very soft and coming in more dovish, as you can see here. Feb CPI dovish, Feb labour market dovish, Feb BOE dovish. All the data is dovish, which is why downside in the pound has been such a clear conviction position this year, and should be until data really changes. Conflict-wise, energy prices are extremely elevated, which is of course going to harm the UK's output / productivity, whilst also rising price pressures, which is why we are, of course, seeing the short end of the curve move to the upside. So we're seeing like the GB 2-year move to the upside, we're seeing the US 2-year. All short-end yields are moving to the upside off the inflation concerns. So that is why you need to be very careful with rate differentials this week, because it's not going to be playing the biggest role. What is going to be playing the role is energy divergent pairs and data. That's what's going to be key. So yeah, data-wise this week, we have GDP, which is obviously we mentioned should be coming in 10 basis points higher, but it shouldn't throw the downside trajectory of the pound off unless we get a massive upside surprise, which is very unlikely, especially seeing the previous month's data. So yeah, bearish on the pound. ANZ are pretty neutral, but Morgan Stanley bearish, MUFG bearish, Nomura bearish. So yeah, bearish on the pound, but it is all about what you trade it against. You'll notice as we go into the euro, we're actually putting our euro pound forecast of upside on a bit of a pause, as right now obviously they're both very energy dependent currencies, and the Europe's getting hit a bit harder than the pound as of now. Obviously, when de-escalation comes in, we're then going to be getting back into these euro-pound longs, but it's a matter of when. So yeah, looking on to the euro, we are bearish on the euro as well, which is another reason why we're not trading against the pound, because it's bearish versus bearish. Same as last week's rally, same as last week really. Europe are getting destroyed from the high energy prices, whether that's oil, LNG or nat gas, which is obviously not good for Europe, and as a result we are seeing markets price in an ECB rate hike this year. However, typically you'd think that would be good for a currency, but rate differentials are clearly not driving price at the moment, and therefore for now this is irrelevant. This is why we're looking for shorts on Euro AUD, Euro NOK, Euro CAD and Euro dollar. That will typically throw a lot of people off when they see the short end spike up like this and markets pricing a hike. Number one, it's clearly not having an impact on the euro, because look at euro pound, which if it is hawkish versus dovish, which it should be off that comment, why is euro pound melting? Why is euro AUD melting? Why is euro CAD melting? It's obviously because right now the market is being driven off of energy, oil prices, nat gas, that sort of thing. So it would be kind of silly to now go, all right, well the ECB are going to hike, we need to get into longs. And also, the ECB hiking doesn't necessarily mean it's going to be very beneficial for a currency, especially in this climate where we're now going to have a massive increase in European production costs from all this energy prices moving up, which means obviously that's going to slow the economy down. And now we're adding rate hikes on top of it. It's like you're just asking for a stagflationary environment, which of course the markets do not like. Markets want to put their money into the most optimistic currencies, the most growth, the ones who are most likely to achieve decent growth. And looking at Europe right now, within the conflict and within what energy prices are doing right now, it's not giving a good enough, it's not appealing enough for investors to get into. So yeah, bearish on energy crosses for the euro. So, Australian dollar. Now, the Australian dollar, we are definitely, actually we'll do the CAD, we'll do it in order. With the CAD, bullish, quite self-explanatory, but as long as tensions are high and oil remains elevated, we are going to see flows into the CAD. Data-wise, short-end yields were on a downside trajectory until the conflict started, which is indicating as soon as there is de-escalation, we should see the CAD give back a lot of its gains. But until then, we are buyers. So yeah, quite a quick one there with the CAD, but essentially, macro-wise, rates-wise, data-wise, it's all looking bearish, but we're in a very oil-driven market, which is obviously amazing for the CAD. So we're going to be bullish on the CAD. Why wouldn't we? But as soon as there's de-escalation, we can see that all the institutions are basically bearish on the CAD. We can see the data's coming in more neutral to dovish, and inflation's falling, the labour market's weakening. There is clear signs of a call for downside CAD once there's de-escalation. So yeah, that's the CAD. AUD, well, AUD, we are neutral. On one hand, we have elevated energy prices benefiting big suppliers like Canada, the US, Norway, etc. However, now with LNG rising, we should also start to be seeing some inflows into the Australian dollar. This is why we have been bearish on pairs like Euro AUD and Pound AUD, whilst bullish on AUD Yen. These are clear energy divergences which make sense of a now, and that's why we're not touching AUD CAD, AUD dollar, AUD NOK. That's why we're not touching them, because there's not a clear energy divergence. Moving on to the New Zealand dollar. Surprisingly, New Zealand actually imports most of its crude oil and refined fuels, making it normally suffer in the current environment. Not to mention that the biggest oil importers in the world is China, which is why the ticker USD CNH is having a pullback, which will put pressure on the Antipodean currencies for sure, especially the New Zealand dollar due to their low energy exports. So yeah, NZD bearish. Pretty, I don't want to say self-explanatory, because not many people actually realise how much of New Zealand's energy is imported. But once again, energy divergence, that's all we're looking for. Which brings us on to the yen. So Japan, I'm pretty sure we mentioned this last week, they import over 80% of their energy, and I believe 80% of their, it might not even be energy, 80% of their crude oil, which makes yen shorts one of the most clear energy divergences at the moment. Yields, as we know, are not driving price at the moment, however, they are also pointing to yen downside, with the long end still being rather elevated and the short end taking a bit of a hit from softer data. And typically, fundamental traders can get caught out by thinking, all right, well, risk off. We're going to see money go into safe havens like the yen. Well, you have to think of context. What's the context? Why are we in risk off? Because energy prices are soaring because there's a conflict in the Middle East. That's not going to benefit Japan. It's going to benefit the AUD, which obviously shouldn't really make sense considering the Australian dollar is a more risk-on currency. If you think in risk-on, risk-off, you'd think the opposite. AUD should be weakening, the yen should be strengthening. However, in reality, we're seeing the opposite because it's an energy divergence. So yeah, that's the yen, and then the Swiss franc to finish on that. Very quick, bullish. At the end of the day, the Swiss franc is the primary FX safe haven and should see some inflows, however suffer against the more appealing energy-based currencies. So something like G-Swiss, Euro-Swiss, that's what we're looking for. So yeah, that is the fundamentals. Now moving on to the technicals. Okay, so starting off with the DXY, we are expecting a bounce from the 98.75. Very passive stop. This level here also looks very appealing, so I wouldn't be surprised if we actually come down here and then bounce. So if you want to be very safe, just cover both the levels and target a 1-to-1. Simple stuff. I think this is a very high conviction position and makes a lot of sense. GU, similar thesis. I think coming up here is going to be perfect for a bounce. 100%. Hopefully we can get tagged in during London session, if not on the market open. G-Swiss, these two levels are screaming to me. I personally obviously like this one at the top. However, if price shows me what I want to see, we'll be getting in here at this zone there. GCAD, similar to GU, I want it to come back up to this level where we caught a nice short last week on Thursday. GA, a bit more careful on GA, but I think this level here makes a lot of sense for a move to the downside. Euro pound, leaving it. That shouldn't have been in the that's not in the watch list. PAD, NZD dollar, I like this. NZD CAD, something like that. Euro AUD, I'm leaving it personally. I think price action is disgusting. Let me just look at it. NZD Swiss, we are seeing, yeah, 0.46 handle is very appealing for sure. AUD NZD, I really like this level. UJ, this level here, just above the 157. AUD Yen, caught a nice long here last week as well on Thursday. I think this level makes a lot of sense for further upside, but you can kind of see there's a lot of hedging going on. CAD JPY, I mean this level here, do we get a pullback to that level? Rather unlikely, but if we do, good stuff. Euro Swiss, same thing here. Do we get a pullback up here? Probably not, but if we do, we're more than happy to take a short position there. Euro CAD, same thing. Euro dollar, same thing there. I like this level a lot for sure. I think if we don't get the rejection from this level, it's going to be this level up here, which I struggle to see personally. So I think this makes a lot of sense. I think the pool NFP print on Friday has obviously pushed this up, which is lovely because it's just going to give us more opportunities to get into downside. Swiss yen, this level here, however, we are so overextended on the 1 hour, so I really doubt we come back down here. But if we do, I'm more than happy to get into some longs. So yeah, quite quick on the technicals this week. If you want to see my watch list, it's all of these here, tagged in red. This is everything I'm looking at. I'll tell you what, let's get rid of Euro AUD. This is everything I'm looking at. And yeah, as always, drop a comment in the comments section of positions you're thinking of taking. There'll be a discount for your first month in the comments as well. So if you're skeptical of getting the terminal, you can get it at half price for your first month to try it out. And yeah, we'll see you in the next Outlook.